Speaking of the short end of the curve, it's been a wild ride for those investors in that side of the Treasury market as traders try to figure out how quickly the economy may recover. Here to weigh in on this debate and to discuss the prospects for this week's Treasury auctions is Ira Jersey, head of U.S. interest rate strategy at RBC Capital Markets. Ira is known for accurately forecasting the Fed's rate targets. Ira, let us talk about this debate, though. Is the Fed coming in later this year? Isn't it? The futures market says yes. Fed's primary dealers say no. Sort it out for us.
Well, we agree with the consensus that the Federal Reserve is going to be on hold for the official policy rate till the end of the year. I think some of the things that you're seeing in the futures markets and in the short end of the interest rate curve is really an unwind of the crisis trade. So it's an unwind of carry trades that people put on, hoping to benefit if there was a real disaster in the economy. Now that kind of disaster has been diverted, but we just have a very weak economy instead, some of those trades are being unwound and being unwound very aggressively.
Does that mean that Fed funds futures are no longer a reliable predictor of how the Fed might act, or at least not a reliable indicator of market expectations?
Well, in the longer term, they will be. Part of the issue is right now is that Fed funds itself is a little bit broken because the Federal Reserve is targeting firstly a range, and then secondly,
and letting it zero.
And correct. I mean, or near zero. I mean, it's been at 20 basis points plus or minus for quite a while. So perhaps that's where they are. But the first thing that the Federal Reserve winds up having to do is actually setting some hard target, and a hike before year end is pretty unlikely given the fact that the Federal Reserve first has a lot of other ways to take liquidity out of the system. For example, just saying that it's going to pay on excess reserves again. They started to do that in order to keep the federal funds rate from trading at zero when they were trying to target 2%. But now they've set that rate at zero. So the first thing that they can do is just say we're going to pay on reserves again. That will drain a lot of liquidity without them having to actually raise the target rate.
And of course, they have all those swap facilities. They have the TALF. They have other stuff. How should the short end of the Treasury yield curve behave if the Fed were beginning to unwind some of those programs, not touching interest rates for the time being?
Well, the short end, the money market curve, and the very short end of the curve should steepen, and I think that's really what you've seen. For example, when last week on Friday, you saw the 2-year move over 30 basis points higher in yield, an event that's only happened 4 times in the last 10 years. So that's a real sign that there is some optimism going out to a year or a year and a half.
Now, quickly before we go, Ira, 10-year auction today, 30-year auction tomorrow. How do you expect investors to respond?
Tale of two auctions. Today's auction we think will go reasonably well. There's a big short base and in the repurchase agreement market, there's some technical issues going on that we think will cause the 10s to go okay. The long bond, we're not as confident about. We think that there could be a problem just like there was in the May auction.
Really? Potentially a failed auction?
Well, you can't really have a failed auction the way that the United States does it, but there could be a tail. If nothing else, you probably won't see the bond come through where it's currently trading.
All right, something to watch closely tomorrow. Ira Jersey, head of U.S. interest rate strategy at RBC Capital Markets, joining us here.